JP Morgan just took delivery of over 12 million ounces of physical silver from COMEX in just 1 month. Not paper contracts, but actual metal trucks leaving vaults, that sort of thing. And here's why that should keep you up at night. It's the same bank that paid nearly $1 billion in fines for manipulating silver prices downwards. So why are they starting to hoard it? Might it have something to do with a $3 trillion time bomb that's ticking in the financial system that almost nobody's talking about? It's the private credit bubble, and it sounds boring, but guess what? Subprime mortgages were also boring in 2007. The insiders, Wall Street, are quietly positioning for what comes next. And in the next few minutes, I'm going to show you the real plan, not speculation, pattern recognition, and I'm going to connect the dots that Wall Street would perhaps prefer you never see. Why are institutions fleeing into physical metals, and why silver specifically might be the most strategic asset of the decade? So this isn't about it being a gold and silver cheerleader. It's about understanding what the best informed money in the world knows that you don't know yet. My name is Felix Prehn. I'm an ex-investment banker. I've seen how Wall Street shenanigans work, mostly from my mentors, because those guys worked in banks for 20, 30, 40, 50 years longer than I have. And Winston back there, who does all the research, of course, around it, he sniffs out all the risk manager in chief. We've also founded the Decoding, where my retired Wall Street mentors teach regular investors like you institutional strategies. We've taught well over 20,000 students over the last 6 years, and it's super, super fun. And explain something I have never talked about publicly. The institutional playbook for monetary system transition. You could say reset, same sort of thing. So this isn't a conspiracy theory. It is literally a pattern that we can see based on what institutions are actually doing. Not what they're saying, but what they're actually doing. So by the end of the video, you'll understand the why behind this crazy silver accumulation. You'll understand the private credit crisis that's brewing, and what I believe is the real plan for what comes next, and how to protect yourself and your family and your money. But before I show you what JP Morgan, Jane Street, and all the other big institutions are doing with silver, you need to understand why they're doing it now. And that means understanding the biggest financial risk nobody's talking about, because again, it does sound boring. Yeah, it will bore the pants off you. But pre-2008, everybody was very, very bored talking about subprime lending. So give this a few minutes and you'll be in a better place to protect yourself and your money. What the heck is private credit? Private credit is basically Wall Street's shadow lending system. It's a shadow banking system. So when banks can't make loans because of regulations that were put in place after, yes, you guessed it, 2008, private credit funds are acting as the bank. Think of it as the Wild West of lending. Bugger all regulation, bugger all transparency, and higher risk borrowers. Now, apparently this democratizes lending and it provides financing to companies that need it. Basically, they're saying we found a way to make really risky loans outside of the regulated banking system so we can collect the higher rates because we're greedy buggers, and we can avoid the rules that were supposed to prevent another 2008. Whoops. Now here it gets a little bit scary, and this is not a doom and gloom video. We're going to be on a very, very upbeat note by the end of this, I promise you. But the private credit market has gone from 500 billion just a few years ago to now $3 trillion. That's kind of a lot of money, right? Buy a lot of tennis balls for this guy. We played tennis this morning. I have a ball machine, but 100 balls come out of our teeth. Just exhilarated by it. If you have a golden machinery, a tennis ball machine, it's amazing. But what am I talking about with the $3 trillion? Well, subprime 2007, which is what tanked the market in 2008, generally known as the GFC, global financial crisis, that was 1.3 trillion at the very peak when it all broke and, went haywire. And some very poor bankers, friends of mine, lost their jobs. Lehman Brothers. It's very, very tragic, very tragic. That was the real tragedy, that, investment bankers losing their jobs. That should never have to happen, right? Those people, they work so hard, forget the doctors and the nurses. All right, let's get back to this. So we have a shadow lending market that is twice the size of what caused 2008, with actually less oversize than what we had in 2008. And you may be thinking, Felix, I don't want to hear the bad news. Give me something positive. All right, I'll give you something positive just in a second, how you can be better informed and make better decisions. But you can't just put the blinkers on and go, la, 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 la. We're not going to want to know, because it's happening. UBS, the Swissies, they just warned that default rates in private credit could spike to 15%. Literally today, a private credit lender in the UK, used to be Great Britain, now it's just Britain or just UK, they can't afford the other letters anymore. They've gone bust, bankrupt, right? Big lender. Someone talking about it? No, because let's keep it quiet. That way everybody doesn't know about it, and we can make some money and we can keep this party going for a little while. But what does that mean? It means 15% of borrowers can't pay the interest on those loans. They can't even repay them, of course not, but they can't even pay the interest. Now, how are they surviving this? They're using something that's called payment in kind. And it's not an Epstein sort of type solution, no. But they haven't got cash. So basically, whatever I owe you in interest, you just add it on top of the loan that I can't afford to repay, not even the interest off. It's like, imagine that. Imagine you have a mortgage that's, $100,000 for the sake of it, making it simple. And that's your mortgage. And say your interest on that was $7,000 a year. But because you can't pay the $7,000 a year, your mortgage just grows. They just make your mortgage $107,000. And the year after, it becomes $114,000. It's a Ponzi scheme, right? Because you can't pay it back. Now, you might have heard of Jeffrey Gundlach, who's one of the most respected bond investors in the world. I'm not sure there's two terms to go together, but let's give him his title. He called this private credit thing the ultimate sin, and said it's going to trigger the next financial crisis. Jamie Dimon, yes, the JP Morgan lobby, Jamie Dimon, he said, when you see one cockroach, there are usually hundreds more hiding, referring to this private credit issue. So if you've never heard about private credit bubbles before this video, maybe let me know in the comments down below. Maybe we can break this down a bit further. Just write shadow bank in the comments, because essentially what this is, and I'll see it, because be curious to see how many people are, not aware of this, right? So let me give you the official kind of translation. When a private credit fund says they have flexible lending solutions for middle market companies, it's basically Wall Street saying we're lending to companies that banks don't want to touch because they are too risky. Now, why should you care, right? You don't own a private credit company and any of that. I'll tell you why you should care. Here's how this works. You have a cockroach, a private lender, right? A private lender. Picture a sort of a loan shark, with great intentions, obviously. You have a borrower who wants to borrow money. But where does the private lender, the cockroach, you know what I'm talking about, where does the money come from? Well, the money's got to come from somewhere, and that money comes from banks. So the banks lend to the private lender, who have a good credit rating on paper, and they pass that money straight on to the borrower who's got fuck all money. Sorry. Pardon my French. So what does that mean? Well, it means in reality, the banks are lending to the guy with bugger all money, and they're just putting somebody in between to cover it up. Right? So why the heck does this matter for silver? Like, Felix, come back to the topic. Okay. The private credit bubble has got everything to do with silver and gold. Because when sophisticated investors, they see this risk, systemic risk, cockroach risk, the ultimate sin risk, I'm quoting, in the financial system, risks that are invisible to you and me because we don't see it, and they start positioning for the fallout. And the fallout from a $3 trillion private credit blow-up, well, it could make 2008 look like a warm-up act. This is why these guys are fleeing into physical assets, not paper, not ETFs, physical silver. It's a lot of silver. Because when there's stress, all these Fugazi paper contracts tend to lose value. So why are they buying silver and not just gold? Why do they insist on physical metal? Well, there is a reason the thumbnail says silver reset. It's not clickbait. It's what happens when you actually read what the institutions are positioning for. So what most people aren't even aware of, silver isn't just a precious metal, it is a strategic metal. It sits at the crossroads of two enormous trends that are coming together. First of all, silver is the most electrically conductive element on Earth. It's essential for what? Solar panels, electric vehicles, AI infrastructure, basically everything in the green energy transition, the thing that's going to save the planet, that stuff. Solar panels consume 25% of annual silver supply. We expect that to double by 2030. EVs use very, very significant amounts of it, 3 to 4 times more than your average gas guzzler. And the whole AI boom thing, all those data centers, they need silver for all the electrical components. So it's just physics. There isn't a substitute for it that works as well. That's the first part. Now, the second part is silver has literally been money for 5,000 years. Always in times of monetary uncertainty, when you didn't trust the government or the printing, inflation, and also confidence in the fiat system, people flee to gold and silver. So you've got industrial demand consuming silver. It actually literally gets used up. Gold doesn't really get used up all that much. Some industrial usage, but not a great deal. But the investment demand is hoarding silver as a hedge. So we've got 5 years of supply deficits. We're drawing down above ground stockpiles. And just have a look at, let me just show you this, COMEX. We have a metal tracking tool with a bunch of stuff in there. And one of the things is, the COMEX inventory, we track that every single day. In March, we were at 120 million ounces of physical silver in COMEX. Now it's 86 million. That's more than a third that's gone missing in less than a year. Crazy, right? Gold, similar trend. It's also sloping down in like an accelerated rate down here. And you can track that every day. That tool, by the way, is like $6 a week or something. It's very, very, very affordable intentionally. And the other thing I like to track is actually Shanghai is a very different market to COMEX, right? Different sphere. And they have a premium for gold and also for silver. And you want to keep track of that because that tends to tell us which direction it's heading into. That's a very, very useful thing to know. We track a ton of other stuff in there too, including you can actually track your own metals, which I think is very, very cool. So you can literally say, if you've got a receipt for silver or gold or something you bought, just upload it. You can also insert it manually, and it'll then track it for you. And that way you know exactly what you've actually got. There's also a ton of other stuff in there. News, data, stock screeners, carry trade, trackers, retirement planners, zombie stocks, and all that kind of good stuff. So like a ton of stuff. If you want to check it out, it's down below. Just subscribe to it for a month. If you hate it, you just cancel it. There's no questions asked on that front. But the point is that these supplies above ground are very, very rapidly diminishing. We have a deficit. So why are the institutions that basically run the paper markets suddenly buying physical silver, insisting on it rather than the paper stuff? Well, the answer kind of gives you the real plan, in my humble opinion. So when you own an ETF like SLV, right, popular ETF, you don't own silver. You own shares in a trust that supposedly holds silver. You can't redeem those shares of physical silver. It's not possible. So who's the custodian of SLV? Who's the custodian of SLV? Go on, you can guess it. Yes, of course, it is JP Morgan. The same JP Morgan that paid almost $1 billion in fines for manipulating a silver market is the custodian of the largest silver ETF. You really can't make this up, can you? So the counterparty risk is there. Well, sophisticated institutions understand something about risk. And when you own physical silver, you don't have a counterparty risk. It's actually yours. The metal is yours. No fund manager, no custodian, no financial system needs to remain solvent for your silver to retain its value. So when you own that, you're dependent on just yourself. Not the ETF sponsor, not the custodian, not the sub-custodians, not the authorized participants. Yeah, they're all part of that world. So if you're positioning for a scenario where the financial system gets some stress and say, $3 trillion private credit bubble blow up, which, could happen. Just ask JP Morgan about it. Well, owning the paper probably isn't a genius move, is it? And that's why JP Morgan probably wants to own physical silver. That's my humble opinion. That's why the smart money now wants physical. Suddenly, it's like they listen, right? Now, does that mean we should put all our money into silver, into metals? No, you don't want to ever go on and all in on anything. It's human nature to want to do that. But JP Morgan is also still buying a lot of stocks and making a lot of money trading. How do they find stocks in this scenario that are more stress resilient? It's very simple. There's a very simple 3-step system that Wall Street has literally used for 50 years. Do you want to learn it? Do you want to learn it? Should I teach it to you? Yeah? If you do, write learn in the comments and I'll actually do it. In fact, I'll do one better for you. I'm actually running a live training session about tomorrow. Literally, we'll teach you how Wall Street finds better stocks than you do. It's that simple. I can teach that to you in about an hour and a half or so. Sign up, felixprehn.org/training. It's free, no credit card reward, nothing at all. Just show up. Be on time, the room gets full. We get 3,000 people limit. We tend to get full, and then people get sad. I don't want you to get sad, but sign up for that, felixprehn.org/training, and show up a little early. That would be my recommendation. So what's the real plan here? Again, it's pattern recognition, which I'll teach you a lot more about. You come and join me tomorrow. As I'm recording this, you're watching it later. It won't be tomorrow, obviously. It will be in the past. But there are 3 warning signs that tell you when the big money is positioning for something major. And the first one is, do as I say, not as I do. So the first warning sign is when what the institutions say doesn't really match what they do with their money. So JP Morgan, right? For years, this bank was accused of keeping silver prices artificially low through spoofing. I'm sure it was entirely, actually, I was going to say they're innocent, but they did pay a $920 million fine for manipulating the markets, probably just because they felt like donating $920 million to the greater good. But yeah, they got caught placing fake orders, basically. It's a trick to manipulate the market. And of course, they are reformed, and apparently they've liquidated their paper positions, their short positions, and they are sitting on 750 million ounces of physical silver. Seriously, crazy, right? That's a lot of silver. Now, I'm not saying I know exactly what's going to happen, but when the arsonist starts buying fire insurance, I kind of pay attention. You have to decide what you do with this information. Warning sign numero 2, the commodity exchange where silver futures are traded, COMEX, right? Those lovely people. They've experienced multiple technical issues right before critical delivery deadlines for physical silver. And there's a simple reason for that. Registered silver, the metal that's actually available for delivery, is, I say here, 88 million. That's actually not true. What does our smart chart say? It says 86 million and counting down. So there is 86 million ounces there. Paper claims are about 240 million. So just a little bit more, 3 times more paper claims for every ounce of real silver. So say half the holders of these contracts demanded physical silver, like JP Morgan has done, well, the system would break, wouldn't it? Yeah, it would really, really break. And that's also why keep an eye on the physical premiums, the actual cost over paper silver, which have gone up quite significantly. And again, you can track that in here. Actually, today's premium is surprisingly low. We'll see what happens tomorrow. And then, numero 3, it is the warning sign of the quiet money. When the really quiet money managers make big moves, well, welcome Jane Street. And maybe you don't know who they are, which is intended. They're one of the most sophisticated quantitative trading firms in the world. They don't advertise, they don't do interviews, they just make money, lots of it, right? Now, they acquired about 20 million shares of the iShares Silver ETF in just 1 quarter, which is rather a lot. They're now the largest reported holder of SLV, which, as we now know, JP Morgan manages, bigger than BlackRock's position. And these guys are known as market makers, which is a weird term that most people don't really understand. I'm very lucky. 3 of my senior mentors are market makers. They run our Goat Academy. And essentially, a market maker provides liquidity. They don't usually make large directional bets. So when a firm like this suddenly becomes the largest holder of silver ETF, it is rather curious what they're seeing in the order flow out. And look, if you've never heard of Jane Street or market makers, just type Jane Street in the comments, because again, I want to see how many people are just starting to learn about the smartest quant firm making big silver moves here, and we can add some more education on that. And if you want that education, come and join me tomorrow at felixprehn.org/training, and I'll break down a lot more. It won't be a silver training or gold training. It'll be just literally the patterns and the rules for picking better things. There could be stocks, there could be gold, there could be silver. It doesn't matter. It's all the same rule, and I'll show that to you. And these are rules that have been around for like 50 years. I didn't make them up. I just learned them from guys who learned them from guys who learned them from guys. And I guess we go back far enough, eventually somebody actually came up with that, right? Winston, was it you? Can't slap you. Why are you hiding behind the chair, Winston? And you see that nose? He's hiding behind me. He's like, come on, let's go out. Stop yabbering about gold and silver. We know all about it already. What everybody does, Winston. Just stand behind me. But there's a fourth warning sign that I've actually just added to this framework. And it is, I call it the CEO cash out. When big banking executives are paying themselves like there is no tomorrow, which is what we're seeing, Wall Street CEO compensation has hit levels we haven't seen since 2006. Let me give you some numbers. Goldman Sachs CEO David Solomon, a man who apparently needs some cash, he's getting paid $47 million this year. Nice 21% increase. Go to your boss and say, can I have a 21% increase like David Solomon, please? Morgan Stanley's Ted Pick, he's getting paid $45 million at 32% increase. Jamie Dimon is getting paid $43 million. Bank of America's head honcho is getting paid $41 million. Wells Fargo's CEO, Charlie, is getting paid $40 million. That's, you know what the total is of that? That's $258 million for 6 people. Now, why does it matter? Look, I don't care what people get paid. And obviously, you were all thinking, how does the Wells Fargo guy survive, right? That was probably your first thought, wasn't it? It's like, how does he afford the 6 houses, the 2 jets, the boat, the 4th mistress? I mean, it's got to be a stretch, right? But why does it matter? Well, this is what they got paid in 2006, which was the year before 2007. And in 2007, we started to see the cracks in the housing market. By 2008, we had the worst financial crisis since 1929. Now, am I saying we're getting another 2008? No, but I'm saying when executives are starting to cash out at these levels, maybe they know something about risk and they're thinking, well, let's just, get some. Right? And maybe you remember Lehman Brothers executives. They're getting record bonuses up to the moment the firm collapsed, literally, right? They're not like, oh, the business is a bit shaky, let's take a little bit less. That is not how bankers work. So, are you concerned about that? Are you concerned about these levels? If you are, let me know. Write it down below in the comments. Just put a dollar sign in there and I know what you're talking about. And before we go into the real plan, understanding institutional patterns and signals is, in my humble opinion, what separates regular investors from the ones who can actually build wealth. So if you want to learn how Wall Street really picks stocks, the actual frameworks that you don't get taught in finance classes, I'm going to teach it to you for free, live on Friday evening, New York time. So just sign up at felixprehn.org/training. It's very quick, it's very easy. And I'm going to walk you through Wall Street's rules for picking stocks, the same strategies that I learned from my mentors who spent decades in banking. And there's a link down below in the description. So if you're serious about, leveling up, which is probably why you're watching this still, show up for yourself. So let's connect all the dots and reveal what I believe is the real plan here, what institutions know that retail investors don't. And our mission here is always to fix that. So first, we have a $3 trillion private credit bubble, which is not good. It's more than double the size of the 2008 bubble. Default rates are crazily high. We literally saw one institution collapse in the UK today. Massive risk. And the banks are basically the ultimate lender for these institutions. Insurance companies, pension funds are exposed. So there's a lot of connections here. This will spread if it goes haywire. And second, we have the most sophisticated institutions in the world are acting, they're positioning now, they're accumulating the world's largest physical silver stockpile. Jane Street became the largest holder of the SLV ETF, and Wall Street CEOs are cashing out like the music is about to stop. So is that coincidence? Well, it's for you to judge. I don't really believe in coincidence. And then the third part is silver sits at this beautiful intersection where we have actual industrial demand, thanks to AI and electricity, EVs and all that kind of stuff. And it is also a monetary metal which provides insurance. It tends to go up when there's inflation and the system fails. We've got 5 years of supply deficits, right? About 800 million ounces have disappeared over the last 5 years. China has classified it as a strategic resource. So how do we put this all together? Well, this is what I think Wall Street's seeing. They've identified massive risk in the financial system, $3 trillion. So they are accumulating physical silvers before retail investors really catch on. They're sort of front-running the market without trying to drive up the prices. And the COMEX buddies are possibly helping with that. Not an accusation, just a thought. And if the system breaks, they've got an insurance policy, which could be worth a lot more than what they're paid for. CEOs are getting paid as much as they possibly can while the music is still playing. So what do you do with all this? I don't get financial advice. I'm not a registered financial advisor. I'm not an advisor or anything other than that Winston wants to go out. You need to do your own research. You need to come to your own conclusions. I can just give you the beginning of it. I can give you the data if you join our community here, and you can see exactly what's going on in here. But there is something that I call an asymmetric opportunity. And my first question is always, is there an information asymmetry? Do institutions know something that most people don't? In this case, yes, I believe so. They have better data on private credit stress because they're actually lending into that space. They understand the physical metal flow better than anybody, although we do our best with all the data we make available to you. And then I look at, is there a structural imbalance? So is there more demand than supply or the other way around? And in silver, the answer is yes, right? Industrial demand, we've covered that. And then I look at, are the insiders, the guys with the most knowledge on this, are they acting on this? I'm not just talking about acting on it. And yes, Jane Street is the #1 silver ETF holder, and JP Morgan is loading up on physicals. So what do I look at? I look at how much silver there is left at COMEX every day. It's very simple. I just open up our little indicator here. I keep an eye on the premiums and the ratios. And yeah, I do read a little bit more about mining data and that kind of stuff because there are potentially some beautiful opportunities in there. And again, we can talk about that more tomorrow. We can look at some miners together and see exactly how to spot those patterns again. And if this information, and I've given you quite a lot of information here, that's always my goal, to overload you slightly, but you can just about take it in still. You're like, whoa, that was a lot. Otherwise, I'm not being respectful of your time. And if you feel this is helpful to give you that kind of framework, just put an F in the comments or a framework in the comments. And again, I'll see what you're getting out of this. But to sum it up, $3 trillion private credit bubble, starting to see the cracks. Bank that is usually the biggest shorter of silver is buying silver. Big bank CEOs are paying themselves more money than they ever have since, 2006. And maybe that's not coincidence, right? But hopefully I've delivered for you and to shine some light on what I think is the real plan, which was the promise and the premise of this video. And if you want to learn how to spot these signals yourself, understand the patterns, and be on the right side of moves, how to follow the money, then join me live at felixprehn.org/training. We're going to have a ton of fun. I'm going to teach you Wall Street's rules for picking stocks, metals, anything with a chart. It doesn't matter what it is. It's all the same framework. And I didn't invent that framework. I learned it from people who've worked in the big institutions for many decades. So if you got some value out of this, come and join me live. And the only thing I'd ask of you is share it with somebody so more people are better informed. And Winston, any final thoughts? Winston, any final thoughts? Sit up. What should people do about gold and silver? He says, I'm not a financial advisor. Better come and join the live trading. Thank you very much for tuning in. We wish you a beautiful day and hope to see you live. While everyone's been obsessing over AI stocks, something historic is happening in the silver market that almost nobody's talking about. We're looking at potentially the perfect storm scenario